You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is, of course, the program where we take you, the raw retail options recruit, and we break you down in the horrible, most painful fashion possible. That's actually Dan's job. And then we rebuild you into seasoned options veterans. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you like this program, we have another show, a new show on the network that I think you're going to love. It's called Options Playbook Radio. It takes kind of what we do in the Bootcamp show and breaks it down into short 15-minute segments every week, breaking down some strategy in some particular depth. Offensive plays, defensive plays. They throw in a lot of sports metaphors over there as well. It's hosted by our good friend Brian Overby over there as well. You can check it out every week, Options Playbook Radio, wherever you find this fine program. And of course, while you're doing that, make sure you check out our Options Insider Radio Network app. You can, of course, instantly stream all of your favorite episodes of Options Bootcamp. You can download them for offline listening if you're going on a plane or on a train. And of course, if you're listening to the show and you have a question or a comment about something that Dan and I are talking about here, then by all means, hit that feedback, hit that email, hit that comment button, and you could shoot us your feedback. And in fact, you can do it all. It's all built into the app. You can shoot us a tweet. You can shoot us a Facebook question, an email. You can even leave us a voicemail directly through the app. It's pretty cool. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the program today, as always, my partner in crime, the yin to my yang, none other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir.
It's really, really great to be back. I was thinking that maybe, Mark, you could come up with some sort of you could redo the Welcome Back Cotter theme and just kind of insert me into that. And
we'll play that every show, the full theme.
Yeah, I think that would be great.
I like it. I like what you're thinking, sir. All right, and we also have a very special guest to join us here on the program today. So without further ado, we're going to roll right on into our roll call segment.
Roll call! You boots listen up while today's guest speakers are announced. Yes, sir!
All right, everybody, welcome to the roll call segment. We don't get to break this segment out as often as I'd like here on the old show, so it's nice to kind of dust it off and use it again. Hopefully, we'll be utilizing it a lot more down the road. And today's guest is Mr. Jim Bittman. He is a senior instructor over there at the Options Institute. Jim, welcome to the program.
Thanks, Mark. It's great to be here. I don't know if I can keep up with you guys and all your energy, but I'll do my best.
Jim, you've been doing this longer than probably Dan and I, not put together, but maybe pretty close. So I think you can hang with us. I'm not too worried. Jim, why don't you go ahead? Speaking of that, since this is your first time on the program and indeed on our network, why don't you go ahead and give our listeners a bit of an overview of your background in the options markets and how you found your way over there to the Options Institute.
Well, I started out at the ripe old age of 30 as a market maker in the CBOE. And back then, all you had to do was put $25,000 into an account at a clearing firm. And so I was one of the first people in the world to take out a second mortgage on my house and come down to the CBOE. And back then, everything was written down on pieces of paper. People didn't know what the heck they were doing. And people learned about put-call parity and arbitrage and deltas. And it's kind of the Wild West back then. And I wasn't the greatest trader in the world, but I survived for 8 or 9 years. And the CBOE started an Options Institute, which is an educational division. And I started out giving tours on the trading floor. And then we started answering questions after the market closed. And the demand for education just kept growing and growing. And so in the early 90s, I left the floor and became a full-time instructor. And now I pretty much trade the way most of the listeners trade. You know, I watch the market from a computer screen. And when I see opportunities, I make trades. But I also answer questions and teach classes here at the Options Institute kind of on a full-time basis.
Now, let's get into that as well. You mentioned the Options Institute over there at the CBOE. I'm sure there are a lot of listeners who may not be familiar with what it is that you guys do over there. So why don't you go ahead and give our listeners a nice overview of the Options Institute as well and what you guys actually do day to day over there.
Well, I mean, our goal is to give people an unbiased look at options, what they can do for you and what the risks are. We don't tell people they can get rich overnight, and we warn them that if they're not careful, they can get poor overnight. And we talk about the basic strategies and how you can improve long-term investment performance and how you can trade if you are so inclined. So we spend a lot of time teaching people about covered calls and cash-secured puts. We talk about ways to protect portfolios. And for more active traders, you know, we talk about spreads and managing position risk.
I think that's an important thing to emphasize, too. I think people might hear, oh, CBOE's Options Institute, all they're going to talk about all day is SPX and VIX. And I'm sure you spend a lot of your day talking about those because those are pretty popular products. But at the end of the day, if they want to come to you and just learn what's a call, what's a put, how this stuff trades, how options actually work in the real world, you guys will do that for them.
Oh, yeah. I mean, 90% of our education on our website and in our classes is not just about, you know, VIX and SPX. I mean, you are a knowledgeable industry participant, and so you know we specialize in that. But most people come in, don't really know that, and we don't force it on them in any way. We just, you know, try and answer their questions. We have a basic, intermediate, and advanced class. 3 different classes, 2 days each, in which we, you know, try and go over relevant topics to the participants based on their knowledge and experience.
And Jim, you know, one of the reasons I wanted to have you on is because I like what you guys do over there. I wish more exchanges would follow your lead. You know, we saw some exchanges dipping their toes into the educational waters in recent years, and a lot of them have since scaled it back. They, I think wrongfully, in my opinion, just view education as just an expense, and they couldn't handle the expense, or they didn't want to pay it. So a lot of them have trimmed their educational staff. Whereas you guys over there at the CBO, not only did you pioneer this stuff with the Institute, but you've since doubled down on education. You're committing a lot more resources to it. You just overhauled your facility to handle more people coming in. So I really like to see that you guys are putting even more emphasis going forward on education rather than less. And I wish more participants in the space, quite frankly, would follow your lead.
Well, thank you very much. We have made a big commitment, and, you know, we don't give all of our classes away for free. So there's an effort to, you know, recoup some of that costs. But I mean, we are committed to education. And to be honest, we talk quite a few people out of using options, just like we, you know, work with the people who are, you know, committed to doing the work that it takes to use options properly.
Now let's talk about that for a minute. What you guys did over there this year at the Options Institute. What did you you rehauled the entire facility from what I've been hearing from people. So what did you guys do, and what can you now bring to the table for people who come in person to some of these events and some of these classes that you couldn't do before?
Well, anybody, I mean, we had a kind of an older classroom with a very weak internet setup and not a very good projector setup. And so now we have a modern classroom where we have market monitors on the side wall where people can watch the market pretty much all the time. If you bring your own computer, you can hook up with a hard wire, or you can use a Wi-Fi in our classroom. And then we have proper lighting so that the room is lit up and the screens are somewhat dark so you can see clearly what's on the screen. And benefit of all benefit, we have comfortable chairs.
And you know what? I can attest that the classroom they have there in the auditorium, it is state of the art. It's an amazing facility. It really is.
Yeah, listeners, you know, if you've ever been to one of Dan's events over there, or we've had some events at the SIBO, you probably had a chance to experience the Options Institute for yourself. Perhaps not the most recent incarnation, so if you're in Chicago, want to take in some in-person classes, that's certainly the place to do it. And of course, Dan, you have some history with the Institute. I believe we have the Institute to blame for luring you to the dark side of education and creating the monstrosity we now know as market taker mentoring. Is that not correct?
It is very correct, and I credit Jim with teaching me how to teach. I was probably his greatest challenge, but hopefully I think my students will say that he did well teaching me.
Now, Jim, you've been teaching students for quite some time, like you said, since the mid-'90s or so. You've gone through many classes, had many people come in and ask you questions about various options topics. And I know what my answer is to this question, but I always like to ask this to people who've been educating for a while to see what their take is on it. What would you say is, to date, the number one question you receive about options when students come in the door? It could be the basic guy, it could be the advanced guy. What is the number one question that you get, and you have received and probably still get to this day when students come in the door?
Well, I mean, a lot of people say, you know, I'm a good stock trader. Is it, you know, can I trade options? You know, or, you know, how different are options than stocks? Something in that area, on that topic. And I have to tell people that, you know, learning to trade options is a different business than trading stocks. It starts with your stock price forecast, but you really need to think differently to trade options. So I mean that's kind of the most frequently asked question, you know. I mean, people also ask, you know, I bought a call and the stock went up. Why did I lose money?
That's the one I was waiting for, because that's exactly what I would usually say. That's usually the answer.
That's a very common question as well. And I mean, another question we get is, you know, I heard I could protect my portfolio with options, but it's so darn expensive, I don't want to do it, you know? And all of these questions kind of stem from a whole bunch of misconceptions about options and a lack of understanding about the way they work. Options are very useful tools, but they're not perfect tools, and they certainly aren't right for every investor in every situation. So you really have to learn. It's like learning a new language. You have to learn to think in a different way, understand how the options work, and then you have to match the characteristics of the option with your specific objective. And it's like anything else. If your market forecast is wrong, then the option strategy is not going to help you as much as you thought.
You know, they're learning the Greeks, they're learning all this other fun stuff. In many ways, it is a foreign language, so there are some fun elements to that. You know, you mentioned the misperceptions people have, and we touched on just a few of them just now. What would you say, in your mind, is perhaps along the same lines the greatest, the largest, the number one misperception that your students have about options?
Well, you know, if they're bullish on a stock and they think it's going to go from 100 up, then they'll buy the 130 strike call because it's the cheapest. And they say, well, the stock went up $3. Why didn't my call option go up $3? And so I think the biggest misconception is that people think option prices change exactly the same way that stock prices change. And of course, the first thing we teach is that that's not the case.
That gets into Dan's book there about the Greeks and all that fun stuff that we spent a lot of time talking about here on this program as well.
That's right. You need realistic expectations. I mean, if I think the stock's going to go up tomorrow, a call option is going to make me so much money. If I think it's going to go up in a month, it's going to make me a different amount of money. And that takes a while to feel comfortable with.
And Jim, before we dive into some listener mail here, if listeners are curious about the Options Institute, they want to learn more, maybe sign up for some classes or even come in and see it in person, where should they go to learn more about it?
We've got cboe.com. We've got a very robust website, and the Options Institute is under the Education tab, along with a whole bunch of free videos and tutorials. But if anybody has any specific questions, anybody is welcome to call me at 312-786-7491. Now, that's my direct number, or you can just do an internet search for the CBOE's phone number and call the operator and ask for me, and hopefully you don't get bounced around more than 10 times.
Wow, you're a brave man giving out your direct line. I don't even do that here on the show, Jim, so you're a far more courageous fellow than I. And of course, listeners, people are always writing in asking, where can I learn options in a little bit more easy, less intimidating way, maybe a free way to kind of test the options waters? Where can I get some great agenda neutral options information? And CBOE Options Institute, a great place to do it. They kind of pioneered the education in the options space. They don't blame them for Dan Passarelli. He's not their fault. But at the end of the day, it's a great place to go and check out a lot of education. And Jim has been kind enough to offer to stay on with us while we answer some of your questions. So let's get right to it. It's time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, you know what time it is. It's time for the mail call. This is the portion of the show where we open up our mailbag and check out what you guys have on your minds. As I mentioned at the top of the show, a lot of great ways for you guys to join your fellow listeners here on the program, make your questions or comments heard. The easiest way these days is just to download that mobile app because it's all kind of embedded right in there. But you can also do it yourself the old-fashioned way. Shoot us an email, questions@theoptionsinsider.com. Find us on Twitter, twitter.com/options. On Facebook, facebook.com/theoptionsinsider. Or, of course, you can always surf on over to theoptionsinsider.com. Leave us a comment, a question in the show notes for this program, or indeed on any article on the site. We'll find it, and we'll route it to the appropriate program. No shortage of ways for you guys to get in touch with us here on the old Options Bootcamp program, just like your fellow listeners did today, starting off with Kevin Duggan, and he writes, "Hi, Mark. Great show." Well, thanks, Kevin. He goes on to write, "I've been listening to episodes for months, but it was only recently that I saw Dan's picture. Shocking. In my mind, I have always pictured Walter White as they sound exactly alike." That's funny. I never thought, Dan, of you and Walter White in the same sentence.
Holy crap, that's really funny.
That is pretty funny, actually. So I didn't know you had the big blue meth empire going on out there in the burbs.
That's a side business.
He goes on to write, "You can imagine my surprise when I saw Dan's pretty face and those curly brown locks. Shave that bean, Heisenberg." All right, so there you go. Some listener mail for you, Dan, in the Breaking Bad vein. He goes on to write, "Short puts, in parentheses, I'm already long calls. If I am certain the stock will move higher fairly quickly, wouldn't it be best to sell the big, meaty, long-term puts? If I sell a weekly for 45 cents and then close it at 20, where's the fun in that? How do you balance term and premium in naked shorts? Thanks, Kevin. Well, there's a lot here in this question. I'm glad to see that you are already long the calls, because if in your scenario you give, you are indeed certain that the stock is going to move higher very quickly, then the long call is a good way to go. But your question about the selling the far off puts versus the near-term puts. Remember our conversations we had in our earlier episodes, and we've touched on it a lot again, about delta. Delta is what Jim was just talking about when you're talking about the calls on the 130 strike versus the 100 strike. Delta is that variable that, of course, determines how your how your option reacts to the movements in the underlying. And we've talked about delta usually in terms of the 1 month option chain, the at the money, out the money, in the money. But also delta has an effect with time. So as you farther you move out, think about it, listeners, how options may work. You don't know where this option is going to move, where the underlying is going to move, and how that will impact the price of that option. So not surprisingly, that delta is going to decrease. So if you sell this longer term option like you're talking about versus what we always talk about here on the show, selling the nearer part of the curve, capturing that exponential part of the decay curve, then you're going to be selling maybe a juicier, meatier option from a premium perspective. But this has a lot of time premium built in. That isn't going to change. That time premium is not going to go away because you sold this option and the underlying moves. It's still going to have a lot of time premium in there, so you're not going to harvest that. And in addition, you're going to have a lower delta, so it's not going to move that much with the underlying popping. So to answer your question, quite frankly, no, it wouldn't be better for you. It might look better, more attractive on the surface. You're going to sell this big meaty thing, but unless you're going to hold it to close to expiration or roll it at that point, you're not going to harvest a lot of that time premium until, like we said, till we get into that exponential part of the theta curve, which is usually in the final month, if not the final few weeks of that option's lifespan. So until you get there, you're not really getting that maximum theta. So I know it may seem more attractive to sell this big meaty thing, but at the end of the day, if you're going to go put selling, and I would think there's better ways to do to capture a pop to the upside in the very near term than just selling the put. But if you're going to do that and you want to capture all of that premium, that is the way to do it, the nearer term type put. Mr. Passarelli, what's your take on that as the man who, of course, wrote the book on the Greeks?
You know, it's kind of interesting. The question actually kind of stumped me because there was an option term used that I'm actually not familiar with. Mark, I don't know, maybe you can help me out. I'm not familiar with the option term certain. I'm not familiar with that as an option term. Certain, do you know what that means?
It's all
Mark?
that meth you've been cooking out there. It's ruined your options knowledge. This guy clearly has deep insight into the underlying, sir.
Yeah. You know, I like what he's thinking, and it makes sense. And, you know, I think what you said for his strategy is extremely helpful. But, you know, we talk a lot on this show. We've talked a lot in the past on this show about protecting yourself. And, yeah, selling those more meaty in the money puts that have a much higher delta, and you're able to get some of that, you know, extrinsic value as well. While it's nice, I'd rather see you sell that option, but then buy a further out of the money put as protection. And I know that kind of blows your whole plan with the extrinsic value portion of it, but you still get to keep a pretty good part of that delta, and you're protected because there ain't nothing certain in trading.
So Jim, since you're our resident guest instructor here on the show today, what do you have to add here for our friend Mr. Duggan, who's confused about longer term puts versus shorter term puts?
Well, yeah, there's two ways of thinking about this question, and I would like to first address the motivation. I mean, it sounds to me like he's selling a put to bring in money to pay for the call, thereby having the illusion, you know, of a zero or close to zero cost strategy. And this is a huge misconception, because when you buy a call, you have a positive delta, obviously. But when you sell the put, you're bringing in cash, but you're also increasing your delta. So if the market goes against you, then your losses are going to be increased, and you're going to have to buy back that put option at a higher price in addition to whatever you lose on your call. So I suggest that, this idea of a free strategy doesn't exist, and you have to decide how much delta you want based on your projected price move. And if you're very, very bullish, then buying the calls are good because you get the positive gamma in addition to your initial delta. But if you're moderately bullish, then selling a put gives you a pretty good delta for a while, and you get time erosion for the moderate price move. So that's the way I'd think about it. But if you are committed to selling puts to pay for calls, then I would want the time horizon of the sold put to be the same as or shorter than the time period of the call, because then, as you said, Mark, you get into the time decay curve. You do benefit from time erosion, but a longer-term put has generally such low time erosion that you're not really going to benefit from time erosion. You might benefit from delta, or you hope to benefit from delta, but you're probably not going to benefit much from time erosion.
There you go, Kevin. 3 different perspectives on your trade. I think all of us are questioning your Karnak abilities to predict the underlying. But that said, if you can, more power to you. You should be teaching the show instead of us. But definitely interesting stuff. And I think, you've got all of our perspectives there. None of us really big fans of that long-term put. We talked about selling short puts on the show in the past, usually as a way to leg into a long equity position to get paid for working a limit buy order in a stock rather than just working a limit buy order in a stock and getting paid nothing. But of course, we talked about the downsides of that as well. And as Dan just outlined, we like to see put spreads often instead of just puts. So there's a lot of ways you can do that. And if you're using it just to finance the calls, again, there are better ways to do that, as Jim just outlined. All right, moving on here to our next question from Josh Norell, and he writes, "Hello, everyone. Enjoy the show. I'm trying to work out the details with a diagonal collar and its adjustments. I want to buy a stock, buy an out-of-the-money put several months out, and sell weekly out-of-the-money calls against it. If the stock rises, I get called away, all is well and good, and I can just buy the stock back next week and do it again. Where I'm confused is when the stock drops below my put strike. What do I do? Because of the put's lower delta, for every dollar I lose on the stock, I'm gaining less than $1 on the puts. So do I exercise the put and lose all of its extrinsic value? Do I roll it down and hope for a retracement? Do I just blast out more calls? A little help, please, Josh." Another question talking and relating back to delta and the time impact on delta. So interesting stuff. First off, let's hit on one of the last parts of your question first here, Josh. Should you exercise the put early? No. The answer to that is pretty much always going to be no. There are a few scenarios where you would want to exercise an American style option early. We covered those, remember, on our dividend capture episode, and that always refers to calls. You're talking about calls exercising early to capture a dividend. That's really the only scenario that 99.9% of you are ever going to ever want to consider exercising an option early. Because remember, what do you do when you exercise an option? Exactly what you say here. You lose all of that time premium that you've built up in that option. So if you buy a very meaty option, you're talking about a 3-month out option or so, it's going to have a lot of time premium on it. If you exercise that, you lose all of that. So you're always going to be better off selling that option as opposed to exercising it, because you get to collect all that time premium. Why pay it and then just give it away? It doesn't make any sense. So definitely, first off, do not exercise that put. But I like where your head is at, because you're talking about one of my favorite positions that I've extolled a lot on this show, which is exactly what you're talking about. This kind of essentially a time collar, buying the longer term put, selling the nearer term options, maximizing the theta on both sides of the curve, the longer term and the shorter term, and really being able to, hopefully, if you do it right, pay for a lot of, if not all of that protection that you have with these weekly type positions. But again, you're starting to discover, like our other writer did, that as you move out, these options have lower deltas, and that's one of the facts of life when it comes into the options realm. Dan, I guess we'll start with you here again, because again, this is another question that goes back to delta, which is your bread and butter. What do you have to say here for our friend, Mr. Norell?
This actually fosters kind of an interesting contemplation of the Greeks. So if the delta is not 100%, so it's not moving in step with the underlying stock like you're talking about here, Josh, then the option's not totally deep in the money. It's somewhat close to the money to some degree. I mean, it could be pretty deep in the money, but it's not so deep in the money that all the time value is gone. Because if an option is 100 delta and is moving in step with the underlying stock, then essentially all the time value is gone. And if you really want to lose the stock under that circumstance, okay, then you could exercise without giving up the extrinsic value. But if the delta is something other than 100 and you have the issue you're talking about, then if you exercise, just like Mark said, you're giving up all that time value and you're throwing money away and you're kind of making a mistake.
And Jim, again, he's talking about a position here that we've extolled many times on the show, financing longer-term protection with some shorter-term options, essentially a time collar. As I think I joked about it last episode that it would be a good name for a movie, the time collar. But of course, our listener here again also encountering the problems of delta as you start moving farther out the option chain. So, what would you counsel to our friend here, Mr. Norell?
Well, this is a very good strategy for an active trader. I mean, the concept is that you buy a 6-month put for $3 and then you sell, short-term options. I mean, the way we teach it, you try and sell monthly call options for $2 so that over the 3 months you bring in $6 of option premium from the calls and maybe a dividend from the stock or $2. And then you lose only the $3 that you paid for the put. So it's not a home run strategy where you make lots of money. Josh's variation, where he's selling weekly calls, is interesting. But again, that's for a very active trader. So the strategy is a sound one, but it really depends upon your opinion of the stock. I mean, he starts out by saying, I'm willing to buy the stock. So presumably, if it dips in price, then, presumably he's willing to hold on to it. So if it dips in price when you first put on the position, then I'd be inclined to just ride it and, see what happens. If it goes back up, then you'd be glad you didn't roll the puts down. On the other hand, if it stays down, then when it comes time to sell a new covered call, it might be a reasonable strategy to roll the put out, down a little bit and out. But you can't get yourself in a situation where you're selling a lower strike call, and if the stock gets called away, then you end up having a locked-in loss. So it's a little tricky if the stock drops too much, but your loss is limited because of the put. And if the stock does drop enough that you get into that situation where selling a new lower strike call would lock in a loss, then my suggestion would be just to close the whole position, take a small loss on this position, and find another stock that you're willing to buy and open, this time collar on it. Because to me, success comes from having, several stocks that you're watching, and hopefully one or more of them are at your buy point, and that's when you buy them and do the time collar. And then for the few that keep on going down, that's the ones where the collar, provides its benefit.
All good suggestions. It's not a bad idea, too, to maybe sit on it a little bit there. And we don't know your outlook on this underlying. Maybe it has changed, but if your outlook hasn't fundamentally changed, you bought an underlying you believe has some bullish value, some appreciation in it. You bought a put to stop you out at a level that you're worried about in case to the downside. So if you have broken through that level, maybe your viewpoint on the underlying has changed, in which case maybe Jim's right, you want to take it off. But also, again, you have that put on, so you don't really need to worry as much. You are protected. I know you're worried about the delta now, but remember, as if you're in the money now, that delta is going to increase as you go further in the money. Also, as time decay passes, that delta is going to increase as well. So you're going to be stopped out of that strike. I wouldn't worry about that. So keep that put on. That kind of, the nice thing about having paid for that put is you get a little bit of security, a little bit of protection, a little bit of ease. You can sleep at night. So if you're worried about this position a lot, then maybe you should take it off. But if not, if you think it's going to retrace, then you can keep doing what you're doing. You could let it retrace a bit, or maybe you can even, if you sound like you're pretty certain it might retrace, then maybe you could do some of the strategies we talked about in the past. I don't know how much it's sold off, so I can't speculate to that percentage, but we have talked about things like repair strategies and things like that on the show as well. So if the stock does bounce back, you could make back what you've lost and more. So moral of the story, you have a put on, relax, you've done the right thing, and now it's time to let it do its magic for a little bit. Let it do its magic for a little bit, and hopefully that'll work out. And if it doesn't, let us know. Write in, tell us maybe your view on the underlying has changed. We want to see how this trade unfolds for you. But we like what you're doing the right thing. Keep it up. All right, next up, this one sounds like it's right up your alley, Jim. This is a question from Inc. 429, I love the handles, and he writes, VXX or VIX options, which is the better hedge for a broad-based equity portfolio? Jim, as our resident guest and also the resident instructor over there at the Options Institute, what do you have to say to our friend here, Mr. or Mrs. Inc. 429?
Well, I have to start with a disclaimer that, I work for the CBOE, and VIX is a proprietary product of CBOE. But I will try and answer this in a totally unbiased manner. And I'm going to say better is a problematic term because they're slightly different strategies with slightly different costs and slightly different payoffs. And I use the term slightly because it depends upon the market scenario. The VXX has a built-in time erosion to it because every month, the VIX holds, the VXX holds VIX futures, and every month they have a system, of course, by which they do this, but they're selling the front month VIX futures at a lower price, and they're buying, longer term VIX futures at a higher price. So there's a built-in erosion or expense to the VXX. And if the market drops sharply, and if the VIX index goes up rapidly, then the front month the front month VIX futures that VXX holds will go up pretty sharply. The back month the VIX futures will not go up as much typically. So your VXX will not go up as much as the VIX index. So you might have a lower long-term cost with VXX, but you are likely to have less of a payoff if the market goes down and VIX goes up. Now, VIX, the trade-off is that the biggest bang for your buck, so to speak, in VIX options tends to be with the front month VIX options, which means if you buy the front month VIX options and they expire, then you have to buy, next month's VIX options. And if they expire, you have to buy the next month VIX options. So you have a known monthly cost to buying VIX options. Now, if VIX pops dramatically, then those VIX options will give you a big payoff dollar for dollar with VIX above your strike price. So the question is how much will VIX rally or spike up if this market decline occurs? And of course, that's unknown. So you really have to decide how much over what time period you want to pay for protection. And that's a very personal decision. The VXX is likely to cost you less over the course of a year than VIX options, depending upon how far out of the money you are. But if you do get a big decline in the market and a huge rise in VIX, then the VXX is likely to pay off less than the VIX options would pay off. So that's a long-winded answer to quite a complex question. It's a seemingly simple question, but there really is no better. The instruments have their own unique characteristics. And, there is no guarantee that if the market goes down, the VIX index will go up. Yes, it's happened always in the past, but there's no guarantee that it will happen as much next time as it did last time.
An excellent answer, Jim. And you're right, it is a bit of a complex question. We've discussed in the past here on the show are taking a dim view of VIX, any kind of VIX product, as a quote-unquote hedge for a lot of the reasons you just described, but we also take probably a dimmer view of VXX just for the reasons you outlined, how it gets just destroyed by term structure on such a regular basis that it's difficult to use that instrument in any sort of buy and hold capacity. You really have to do it on a very short-term basis. But you're right, if you are looking at the two, I think Jim outlined some very good pros and cons of each. So hope that answers your question there, Mr. or Mrs. Inc. 429. Next up, we have a question from Buckeye. I'm guessing he's from Ohio. I could be wrong, but you never know. But probably from the Ohio region. He writes, I enjoyed the discussion about the percentage of a portfolio one should devote to hedging on the last episode. Remember, Dan, we had this conversation just on the last episode. He goes on to write, I do have a question about the 1.5% to 2% figure discussed on the program. If that was for a 3-month put, then you're talking about 6 to 8% on an annualized basis. Given that most funds only return about 7% a year, won't that eat up all of the profits in your portfolio? Or am I missing something? Thanks again for this excellent program. It is truly a unique source of options education. It makes my long trade ride that much more bearable. Well, you're welcome, Mr. Buckeye. Glad we can make your commute there a little bit more tolerable. That is one of our goals here on the program, as well as education, of course. And you're right. What we were talking about on the last episode is actually about the gains. We were talking in particular about locking in gains and how to defend the gains that a lot of you are sitting in your portfolio right now. We, of course, have been in an extended bull market. And so a lot of you are sitting on gains, which is not a bad problem to have. And you're worried about how to protect those while also still having some upside capacity in the market in case the bull market continues. And that's what we were outlining there. Is a very specific use case where we talked about buying meatier, much better protection than you may normally, where you probably would buy an out-of-the-money put and try to save some money that way, or do a zero-cost collar. We were talking about buying closer to at-the-money, if not at-the-money puts, and protecting that way, and some ways to mitigate the outlay. But at the end of the day, we said somewhere in that ballpark of 1.5% to 2%, you should be willing to outlay around that percentage to really get quality protection for your portfolio if you're sitting on gains. And you're right, if you're doing that every 3 months, that would eat up a lot of your portfolio. But we weren't really specifically talking about doing that all year round. It really was a one-off way to protect the gains in the scenario we're in right now. So if you're sitting on gains, you're probably not going to mind giving up a little bit of them in order to protect them and lock them in. And that's kind of what we were talking about there. If you're going further on, you want to have rolling type coverage. Now you're starting to see the reason why all these other strategies we talked about have been invented over the years. The zero cost collar, the time collar like we were talking about before, and all these other strategies that we've outlined to try to mitigate the cost of that protection, because as you've rightfully outlined here, good protection is expensive. And so, as Jim mentioned at the top of the show, that's one of the common complaints people have about coming to options. Wow, these puts are so expensive. So there are a lot of strategies that we've outlined to help reduce that, mitigate that if you are going to do this on an ongoing basis. But what we were talking about specifically is that scenario where you want to really lock in some gains and you don't mind giving up a little bit of your profits in order to do that. Jim, I'd like to extend that question to you as well, because I like to kind of get everyone's input and feedback on this. What we mentioned on our last program was kind of that ballpark figure because it's a question we get a lot. What percentage of my portfolio should I be allocating towards, protection if I have some gains in there? We kind of came down in that 1.5% to 2% range for a decent put, somewhere in the 3 to 6 month range with decent, close to at the money strike. Is that a ballpark percentage you come down to as well, or is your number higher or perhaps lower?
Well, the question points out the excellent concept that 2% for 90 days is 8% a year, and 8% a year is generally too much to pay to insure a portfolio, because most funds don't go up much more than that every year over the long term. So the concept is you cannot insure your portfolio like you insure your house. You insure your house every year. You buy an insurance policy that covers you for the whole year. When it comes to portfolio insurance, you have to view it much more as a case-by-case basis or a market timing kind of strategy. But having said that, yes, 1.5% to 2% is a very reasonable amount to spend. I mean, if I am convinced that the market's going to go down in the next 3 to 4 months, then I should be willing to spend 2% of my portfolio to protect my portfolio. So if the whole market drops 10 or 15%, well, I might lose 3% down to the strike price of my put, plus the 2% cost of the put, for a total of 5% loss. And if the market goes down 8 to 15%, well, I'm way ahead of the game. On the other hand, if the market goes up 5 to 8% during the next 90 days, because I'm wrong on my bearish forecast, then losing 2% is not going to kill me. It's what you call a cost of doing business. I mean, last year, 2013, I knew a ton of people that were bearish going into the September-October period. And the ones that spent 2% on puts were very wrong, but they were in their portfolio and they profited as the market went up at the end of the year. The people who sold their stocks because they were bearish, they were equally wrong, and they did not participate at all in the year-end rally. So I think 2% is a reasonable thing to do if you are that bearish.
Yeah, I agree with Jim on the not necessarily having the protection on all the time. And of course, the challenge is, when do you put it on? And I mean, I kind of have some thoughts on this, and I was thinking about it while Jim was talking about what I was going to say, and I realized this is probably going to sound oversimplified, like, oh, you just do this. And it's definitely a lot more complicated than what I'm laying out here. But when you get into a situation where the market is up like 20%, on a year basis or something like that, or 10% on a smaller basis, traders and investors should appreciate that the market doesn't simply go up forever. I know that when the market is up and it's been in a bear or a bull run for a long time, and I tell people, hey, you should plan for maybe the market pulling back, they look at me like I'm the devil or something, throw tomatoes at me. But, the market just doesn't go up forever. So if you've been in the market, you've enjoyed pretty good gains, it's a very reasonable cost of business at that point to go in there and maybe consider spending 1.5% or something like that of your gains. Now, when the market's at the bottom of a cycle, it's at the low point of the last 6 months or a year, maybe not the best time in the world to go in and buy puts. So although timing the market is a challenge, and boy, I don't know anybody who can just call the market every single time or anything like that, but you can set some parameters for yourself that are somewhat logical. Hey, once the market is up, it's probably going to pull back at some point, and I have some gains, and I can afford to spend some of my gains on protection. I mean, you can somewhat time it rationally and justify the expense when you look at market cycles like that.
Well said, both of you. Excellent stuff. I wish we have a lot of you guys are writing in. Wish we had more time, listeners, but unfortunately, that is all the time we have for the mail call segment. It's also all the time we have for this episode of Options Bootcamp. But before we go, as always, allow me to check in with my cohorts here on the old Options Bootcamp Drill Instructor Squad. Starting off with our guest instructor for today, Mr. Jim Bittman from the Options Institute. Jim, before we go, why don't you go ahead? We mentioned where people can find the Options Institute and how they could check out what you guys do. Why don't you give our listeners maybe a little tease of some stuff you may have coming down the pike, some interesting classes, some interesting events you may be holding at the Options Institute that they may want to check out?
Well, thanks, Mark. Well, just come to our website, cboe.com. We've got some webinars of all types coming up on a weekly basis. That's all free. We've got a 2-day intermediate class coming up in the last week in June, and we've got our advanced class we're planning for October. So these are all kind of on the radar. We've got kind of quarterly basic and intermediate classes, and we've got our really advanced class is in October this year. So thanks for asking, Mark. It's been a lot of fun talking with you guys.
We enjoyed it as well. Definitely have to bring you back on again down the road, Jim, because this was really fun. And before we go, Mr. Passarelli, what's coming down the pike? One more time. What's coming down the pike over there at Market Taker? Didn't you guys just have an event at the CBOE yourself?
Yeah, we had our first ever in-person event. I think I'm going to be calling it first annual in-person event. It was a 2-day event. It was really super fun. Oh man, we held it at the CBOE in their state-of-the-art facility. Had a nice, intimate little group, really got to know each other, did a tour of the trading floor, took some limos up to the Cubs game to watch the game from a rooftop, had a little reception there. Really, really fun time. Now what we're doing this week, the week we're recording this show, we're accepting applications for one-on-one coaching, which we do twice a year, and I'd actually hoped to talk about that and say, hey, by the way, if you're interested in one-on-one coaching, but we actually this time had more people apply for our one-on-one coaching program than we ever have, ever. Anytime we've ever publicly accepted applications, we've never had this many people apply. So we actually stopped accepting applications, but for those of you who are interested, you can email us at info@markettaker.com, and we can put you on the waiting list, and when spots open up, we'll give you a call and see if it's right for you.
Amazing. People listen to you on this show every month, a couple times a month, and they still want to take your classes. Unbelievable, sir.
I don't know. What's wrong with these people?
All right. And on behalf of Mr. Passarelli and indeed our guest, Mr. Bittman, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program. And of course, for sending in such great questions. Keep them coming. If we didn't get to you this episode, we'll try to get to you on a future episode. And of course, we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.